Yesterday evening, I had CNBC on in the background, and some of the analysts were and talk hosts were talking about Tesla stock and giving their analysis. I really fundamentally disagreed with some of their opinions, so I want in this video give my analysis on it. It's a short clip. I'm going to play the clip, and I will interject in between to give you my opinion.
All right, welcome back to Fast Money tonight. We've got a bit of a buzzkill on Tesla. The stock down almost 7% today, erasing its gains, now negative on the year. And there are some new concerns that Tesla's Cybertruck could be delayed. There are reports the company removed the reference to the year 2022. Need I remind you, that's this year, from its website around production timing for the truck. Something to keep an eye on. Will that truck be delayed?
So on this first point, I obviously have no contention there since they're really just reporting the news given all the articles that came out on the Cybertruck potentially being delayed. What I would say is that it's definitely not confirmed yet. We have to wait until the Q4 earnings where Elon said that he will give a product roadmap. I would say that this is maybe it had some pressure on the stock, but we have to look that the NASDAQ was down big yesterday, and this is really just a continuation of growth stocks getting hit because of the macro environment and the potential of rising interest rates and quantitative tightening. So I would say that this is just the continuation. Maybe the Cybertruck put some pressure on, but I would not think that this is the reasoning for why the stock was down so much. As well, I typically see this as a non-event because even if the Cybertruck was delayed, say until 2023, Tesla always executes on their promises, even if it is not in the right time frame. So if the revenue is not today, it will be next year or the year after. And really, Tesla is battery constrained. So every single cell that they receive is going into another vehicle. So whether it's in a Cybertruck or in a Model Y or Model 3 or potentially even the Semi, that doesn't really matter to me. They're going to have to ramp up battery production in order to execute on all of these different vehicles that they have. So for now, I don't think it actually even harms their financials in any way because the batteries will go somewhere. And this is why I believe also the energy business is still so small because their focus is probably more in the R&D of things, and the actual ramp up will come once they have the sustainable battery production lines.
Tim, but I do wonder, I know we love to talk about EVs, right? Because they're such fast growers. I get it. But I wonder if we're just discounting and forgetting the core business of GM and Ford. The fact that most Americans are going to buy a Chevy Tahoe, which, by the way, now costs like $80,000 fully loaded, and the profit margins have got to be high. EVs are sexy, but even if they're 10% of the market, they're still 10% of the market.
So this last point for me kind of sums up Wall Street's typical short-sightedness when it comes to investing. So the talk host talks about how EV market share is still only and really under 10%. So why are we focusing on that if the legacy business is still most of the market and that's where the valuation should be? But I would say investing is really about looking out into the future and understanding where the market is headed. So how do I profit from that? And we know that given S-curves, which is basically that if it took, say, 10 years for the market to hit 10% penetration, then over the next 10 years, it can very well hit to 90 to 99% penetration. It's an exponential growth. And because of this, investors are not looking at the now. Yes, right now, because of inflation, auto prices are extremely high, and the ICE internal combustion engine is doing a lot better in terms of volume. But investing is about investing in the future, and that's why investors are focused on that future. Next clip, Tim Seymour, who I will be commenting on, actually kind of agrees with this initial point, but I will disagree with his fundamental analysis or viewpoint on Tesla.
Well, yeah, and by the way, you joke about the Gremlin, but I know you were driving an AMC Pacer in high school. And by the way, that probably made you cool. So
a Hornet.
It's all good.
Actually, a Hornet.
I think
we rolled it. We rolled a Hornet.
All right.
I'm not kidding.
So I believe you. I believe you. So look, you have a case here where the analysts are actually starting to question what the value is of the internal combustion engine business. And if you look at a lot of the analysts, in fact, they're giving the legacy business almost zero terminal value on DCFs. So actually, it really is turning into only an EV call, which should make Ford and GM that much more valuable on multiple. Because guess what? Tesla is a car company, right? It's a car company, and that's how we're valuing it. I know we tried to do 15 other things, and great for the people that were long, but it's a case where that's why you need to value GM and Ford more like an EV play. Ford's.
So Tim just reiterated that Tesla is just another car company, and he has been always kind of bearish on Tesla, and at one point he even had a short. He did start talking a little more positively about Tesla, but I think he's still missing the bigger picture. And I think that this could hurt investors because what Tim is saying, either Ford and GM are going to grow to Tesla's valuation because now they're adopting EVs, and if they start to get to the same kind of volumes, then they deserve that market valuation, or that Tesla is extremely overvalued. So if you're holding Tesla, then you should sell it. Like, those are the only two ways about going about what he said. Now, I fundamentally disagree with that because I don't believe that Tesla is just another car company. I mean, look at all the other car companies that have existed until now. They pretty much are assembling different products that then the end result is the automobile, and them switching to the EV is pretty much getting just different parts, assembling them, and then again, they created that automobile. When it comes to Tesla, they are vertically integrated, which means they are, like, for example, in 2000 and I think it was 16, they were getting chips from NVIDIA to support their autopilot systems. And they understood that NVIDIA is moving too slow when it comes to autopilot. So they decided that they are going to do it on their own. And they actually manufactured their own chip through their own R&D. And that is now what's in their car. They also reproduct the batteries that they receive. So they're pretty much also a battery company when it comes to this. And they also are dealing with their own infotainment when it comes to software and when it comes to the future of full self-driving and soon to be insurance. And really what we see is that Tesla is just a bunch of different startups that happens to now put their different expertise into automobiles, but really what they're creating when it comes to chips, software, neural nets, is products that can be beyond the car, which is their next focus is energy, and they discuss the Tesla bot. And like, you can't really compare this to another automaker that has none of this. They assemble a vehicle and it ends there. Tesla is way beyond this. Their market is way beyond just what the automobile has to offer. And yes, their automobile margins are better than ever, and that's in it of itself a reason to value them more than other automakers. But looking forward, if, like, we see now that Tesla's a $1 trillion+ market cap, clearly investors globally see this opportunity, and they're not just putting their money in a $1 trillion+ company because they see it as just another automaker. They're putting in it because they have the foresight to see everything that Tesla is creating, how they're vertically integrated, and what that means for future products that and margins that they create. So I actually do plan on working on a more in-depth video of Tesla this weekend, and really it's going to be about why I still hold every single share of Tesla that I own, and why I see it as a good long-term buy even at these levels. Winners typically stay winners, and yes, it's hard to buy after seeing a stock go up so much, but hopefully my analysis could give some indication of why Tesla still deserves that buy rating. Thank you so much for watching. Please like and subscribe, and let me know if you have any specific videos that you would want me to do, and if you have any other questions about Tesla or something that I should incorporate in the upcoming video on it. Bye for now.